Welcome back to the deep dive. Today we're looking at something that feels, I don't know, less like a software update and more like a tectonic shift in how the economy actually works.
That's a good way to put it.
We're talking about Salesforce,
Yeah.
but I need you to, forget the Salesforce you think you know. We are not talking about the dashboard where sales reps grudgingly log their calls anymore.
No, not at all. What we're looking at here is a, a fundamental restructuring of their entire business model. We're analyzing their incredibly aggressive pivot toward what they're calling digital labor.
Digital labor, that phrase right there, that's what jumped out at me immediately.
It's the core concept.
Yeah.
For, 25 years, Salesforce sold tools for humans to use. Now, based on everything coming out of their Q3 fiscal year 26 earnings call, which is dropped in December of 2025, they're shifting to selling the employees themselves.
Autonomous AI agents.
Exactly,
Yeah.
autonomous agents.
And we have a serious stack of sources to get through. We've got the full transcripts from that earnings call, the technical details on that massive $8 billion acquisition of Informatica that finally closed.
Back in November, right.
And a whole pile of analyst reports breaking down the actual adoption numbers.
And we have to talk about the vibe shift, too.
Yeah.
Because usually this kind of enterprise software, it just stays in the boardroom,
Right.
But Salesforce is taking this completely mainstream. They've already teased a Super Bowl ad.
Yeah.
And it features Mr. Beast.
Which is just wild. I mean, you put Mr. Beast in a Super Bowl ad, you are not just talking to the chief information officer anymore.
Not even close. You're signaling a massive mass market cultural shift. They want everyone, CEOs watching the game with their families, me, to see Agentforce as just the new normal. It's a huge confidence play.
Okay, so the mission for this deep dive is to really unpack this pivot. They're moving from traditional SaaS software as a service to what they're calling the agentic enterprise. And the big question, the thesis we need to test is this. Can this gamble on their new platform, Agentforce, actually justify their target of hitting $60 billion in revenue by 2030?
That is the $60 billion question, isn't it? And to answer it, we have to strip away all the AI hype and just look at the scoreboard.
Yeah.
Because the numbers coming out of this last quarter suggest something very, very real is happening.
Okay, so let's start there. The headline stat from the earnings call. Management claimed Agentforce is the fastest growing organic product in Salesforce history. Is that right? Faster than Slack, faster than the original Sales Cloud.
Faster than all of it, yeah. If we look at the Q3 FY26 data, Agentforce annual recurring revenue, ARR, it hit about $540 million.
Oh, wait, hold on. Let's pause there. $540 million. For context, how big is that really?
I mean, it's a 330% increase year over year. To put it another way, getting to $500 million in ARR, that usually takes a successful SaaS startup, 5, maybe 7 years?
Yeah.
Salesforce did it with Agentforce in about a year.
That is just explosive growth.
It is. And if you zoom out just a little and you look at their combined AI and data segment, so that's Agentforce plus Data 360, which is just their rebrand for Data Cloud.
Right.
That whole segment is already sitting at nearly $1.4 billion in AR.
Mm-hmm.
And it's growing at 114%.
But I have to play devil's advocate here. In enterprise software, companies love to bundle new things in. Are customers actually, are they turned these agents on, or is this just shelfware sitting in a contract somewhere?
That is absolutely the right question to ask. But the sources, they provide the usage data to back it up. They highlighted that 3.2 trillion tokens were processed in the quarter.
3.2 trillion.
Trillion. Yeah, that implies real heavy usage. You don't burn through 3 trillion tokens on a pilot program or some demo.
Sure.
But honestly, the most compelling number, the one that really proves the thesis for me, is what they're calling customer zero.
Customer zero, as in Salesforce itself. They're eating their own dog food.
Exactly. They are proving the entire concept on their own payroll. The transcript details how they applied Agentforce to their own customer support operations. And the result was, well, it's pretty stark. They reduced their support headcount from roughly 9,000 down to 5,000.
Whoa, let's stop and unpack that for a second. 9,000 people down to 5,000. That's almost a 50% cut.
It is. Now, they were careful to note that this was largely through attrition. So people leaving and just not being replaced rather than, a single day of mass firings.
Mm-hmm.
But the headcount reduction is very real.
And what happened to the service? Because usually when you cut half your support staff, wait times go through the roof and customers get furious.
And that's the aha moment right there.
Yeah.
Despite that massive drop in human headcount, they maintained their service levels. They handled 1.4 million conversations with a 77% resolution rate
Yeah.
using these agents.
See, that is the sales pitch. It's one thing to show a CEO a PowerPoint deck about efficiency. It's a totally different thing to say, look, we run a massive public company, we cut 4,000 jobs, and the wheels didn't fall off.
Exactly. It creates a permission structure for other executives. It validates the whole digital labor idea. They aren't just selling you software anymore. They're proving you can decouple your revenue growth from your headcount growth.
Why is this working now? We have to address the elephant in the room. We've had chatbots for a decade. They were awful. You'd get stuck in a loop trying to reset a password and eventually just scream representative into the phone.
Right.
What makes Agentforce different?
To get that, we have to look at the strategic pivot. The sources call this the shift away from DIY AI.
DIY AI, do-it-yourself AI. That was the big story a year or two ago, wasn't it? Everyone was just going to build their own.
Correct. When GPT-4 and the big LLMs first came out, every CIO thought, oh, I'll just grab an open source model, throw it on some GPUs, and build my own internal bot.
The gold rush phase?
Exactly. But it quickly turned into the failure mode. Large enterprises tried to build their own AI stacks, but they all hit a wall. A raw large language model is. It's incredibly smart. It can write a sonnet, it can code in Python, but in a business setting, it lacks two critical things that Salesforce owns: context and execution.
Context and execution. Let's break those down because they sound a little like buzzwords. What do we actually mean by context here?
Context is the data. It's the memory. A raw LLM basically has amnesia about your specific business. It doesn't know your customer shipping history or their previous complaints or their contract terms. All that data has to be piped into it to make it useful, and that's incredibly difficult to do.
Okay, so the raw brain doesn't have the memories. What about execution?
Execution is the hands. A raw LLM, it can write a beautiful email apologizing for a late shipment, but it can't securely log into your inventory system, process a refund, update the supply chain record, and then trigger a new shipment. It can talk, it can't do.
And this is what Salesforce is calling the last mile problem.
Precisely. Salesforce's argument, and it seems to be winning given what they call the boomerang effect of customers coming back after failing at DIY, is that they own that last mile. The AI is integrated directly into the apps where work happens, like Sales Cloud or Service Cloud.
So the agent isn't some brain in a jar. It's sitting right inside the software that controls the bank account and the inventory.
Right. It has hands. It can actually pull the levers of the business.
So companies tried to build it themselves, realized they were just building very expensive chat boxes that couldn't do any real work, and now they're boomeranging back to the platform that holds all the data.
Correct. But having the hands, the execution part, that's only half the battle. You also need the data to be accessible. And this brings us right to the tech stack, and specifically that huge $8 billion acquisition of Informatica.
I wanted to ask about that. $8 billion is a massive check to write, especially when Salesforce already has Data Cloud. Why was Informatica so important?
It's crucial because of where the world's most valuable data actually lives. We like to think everything is in the cloud now, but it just isn't. A huge amount of banking data, insurance, healthcare, it's all still sitting on old on-premise systems and mainframes.
The dusty basement of the enterprise.
Exactly. The systems that were built 30, 40 years ago. Salesforce is cloud native. It's terrible at talking to a mainframe from 1990. Informatica is the bridge. It unlocks all that legacy data so the AI can actually use it.
So if I'm a bank, my AI agent needs to see the transaction history on the mainframe to approve a loan. Informatica is what makes that connection.
Yes, and once that connection is made, Salesforce uses a technology they call zero-copy federation.
Zero-copy federation. I saw that phrase in the technical notes. What does that mean in plain English?
Think of it like streaming a movie versus downloading it. Traditionally, to analyze data, you had to copy it from your database over to your analytics tool. That's like downloading the whole movie file. It takes time, costs a ton of money to store, it creates security risks. Zero copy means Salesforce just streams the data.
So if my company has petabytes of data sitting in Snowflake or Databricks,
Salesforce just federates the view. The agent can see the data in Snowflake and see the data in the mainframe through Informatica, all without ever moving a single byte of data. It lowers the cost and the friction for the customer immensely.
that makes perfect sense. It removes the whole data migration project excuse for not buying. But there's one more technical hurdle that the sources keep mentioning: trust. How do you stop the AI from hallucinating? How do you make sure it doesn't offer a customer a free car when it's only supposed to offer a coupon?
This is the classic rogue chatbot problem. Salesforce addresses this with something they call hybrid reasoning. And this is a distinction the sources really emphasize: probabilistic versus deterministic.
Okay, let's unpack that. Probabilistic is the creative side.
Yes, large language models are probabilistic. They predict the next word. They're creative. They're conversational. They're good at nuance. But they are very bad at following strict rules 100% of the time.
And deterministic.
Deterministic is just pure rule-based logic. If X happens, then do Y. No creativity, just obedience. Think like an accountant or a computer script.
So how does hybrid reasoning combine the two?
The agent can be conversational using the LLM, so it can understand what you're asking in plain English and be polite. But when it comes time to actually execute a task like calculating that refund, it is forced to follow a strict Agentforce script, which is a deterministic set of rules.
So it can chat like a human, but when the money is on the line, it's locked into a script so it doesn't give away the farm.
Precisely. And that reliability is what's allowing them to sell this into highly regulated industries like banking and healthcare. A hallucination in those fields isn't just an embarrassing screenshot. It's a massive compliance violation.
It effectively puts guardrails on the creativity.
Right.
Okay, so we have the tech, we have the demand, but let's talk about the money, the business model. Because traditionally, Salesforce charges per seat. If I run a call center with 1,000 people, I pay for 1,000 licenses. If I fire half of them and replace them with Agentforce, doesn't Salesforce lose revenue?
And this is the fundamental shift. They're moving away from seat-based pricing to consumption pricing. The standard rate mentioned in the sources is roughly $2 per agent conversation.
$2 a conversation? That sounds kind of small. If I'm paying $100 a month for a human license, does $2 a pop really add up?
It adds up fast when you think about the volume. But the real magic for their revenue, and this is what Wall Street is just starting to wake up to, is what they call the multiplier effect.
The multiplier effect. Okay, how does that work?
The management data shows that for every $1 a customer spends on Agentforce, it drives a 3 to 4 times uplift in their total annual recurring revenue.
3 to 4 times. Why?
Because you can't just buy the agent in isolation. To make that agent actually work, you have to upgrade your data cloud capacity to feed it information. You have to integrate your core apps like Sales Cloud and Service Cloud. You have to make sure the security layer is turned on.
I see. So the agent is the tip of the spear. It just drags a huge amount of infrastructure spend along with it.
Exactly. The agent is the shiny object, but the infrastructure is where the real money is. It turns Salesforce from just a software vendor into more of a utility provider.
And to make this easier for big companies to adopt, because counting every token or conversation can create anxiety, they introduced the AELA.
The Agentic Enterprise License Agreement.
Right. It sounds like an all-you-can-eat buffet for AI.
That's a perfect way to describe it. Large companies pay a flat fee for unlimited agent usage. It's a risk-sharing model. Salesforce wants them to get addicted to digital labor without having to worry about the cost of every single conversation.
It removes the friction. Just pay the fee and turn the agents loose.
And once a company builds its core workflows around those agents, the switching costs become incredibly high. You're not just switching Baco anymore. To leave Salesforce, you'd effectively have to fire your entire digital workforce.
That is a very sticky business model.
Very.
So let's look at the financial outlook. They've set a pretty ambitious target. $60 billion in revenue by fiscal year 2030. And they keep talking about a Rule of 50 financial profile. What does Rule of 50 mean?
The Rule of 50 is a benchmark for elite software companies. It just means their revenue growth percentage plus their profit margin percentage equals 50 or more. So if they grow revenue at 15% and have a 35% margin, they hit the rule. It signals a very healthy, profitable, growing business.
But looking at the stock analysis in our sources, there seems to be a disconnect. Salesforce is trading at a discount compared to its peers.
It is. It's trading at roughly 22 times forward earnings. You compare that to Microsoft or ServiceNow, and it looks cheap. The market is still skeptical, and this brings us right to the bear case versus the bull case.
Let's start with the bears. What are they so worried about?
The bear case is pretty much one thing: seat compression.
Which goes right back to that cannibalization fear we talked about.
Exactly. The fear is that AI is ultimately deflationary for software seats. If Agentforce is really successful, companies will need fewer human workers. The bears worry that the revenue from all those $2 conversations won't grow fast enough to replace the lost revenue from the expensive human licenses.
So they're digging their own grave, basically.
That's the fear. Plus, there's still intense competition. Microsoft Dynamics 365 is growing at 23%. ServiceNow is a massive threat in workflow automation. There's things Salesforce might be getting squeezed.
Okay, and the bull case. Why are the optimists so optimistic?
The bull case is that this is a massive reacceleration. The sources point to a key metric called net new AOV average order value. For the first time since fiscal year 22, net new AOV growth actually outpaced their total growth.
Which signals that the new deals they're signing are getting bigger.
Significantly bigger. It signals that the multiplier effect is real. Companies aren't just swapping a human license for a robot license. They are expanding their total spend because they're getting so much more value. They're effectively outsourcing their labor costs to Salesforce.
That is a key point. They aren't buying software, they're paying for labor. And corporate labor budgets are much, much bigger than IT budgets.
Exactly. That is the fundamental expansion of their total addressable market. If Salesforce can capture even a tiny fraction of the wages that were formerly paid to support staff, the stock is, well, it's drastically undervalued at 22 times earnings.
So, to bring this all together, we have Salesforce attempting what one of the sources called a strategic amputation of the DIY AI market. They're basically saying, stop trying to build this yourselves. It's too hard, it's unsafe, and it doesn't connect to your data. Just use ours.
Risk defined. Portfolio protected. That's the verdict I keep seeing. They have successfully transitioned from a tool for humans to a platform for digital employees. They've built the data moat with Informatica, they have the distribution, and they have the trust from regulated industries.
It really feels like they're betting the entire company on this, but they've done everything they can to stack the deck in their favor.
They have. And if you look at the trajectory, they are positioned to become the operating system for the automated enterprise.
Before we wrap up, I want to leave you with one final thought. It's something that kept nagging at me while I was reading through these transcripts. We are looking at a future where a company can pay $2 for a conversation that does the work of a human.
Right. The economics are they're undeniable.
So if Salesforce is successful here, we aren't just looking at a software upgrade. We are looking at the fundamental decoupling of revenue growth from headcount growth for the entire global economy. Companies will be able to scale almost infinitely without hiring more people.
It completely changes the definition of what a company even is. You could have Fortune 500 revenue with a startup-sized staff.
But here's the provocative thought. Salesforce has spent 25 years selling software to humans. Think about the career path. An entry-level employee uses Salesforce, they learn the business, they become a manager, and eventually they become the decision maker who signs the big contracts for Salesforce.
The whole ecosystem of talent.
Exactly. So if all the entry-level jobs, the support tickets, the data entry, the first rungs on the ladder, are taken over by Agentforce, who trains the humans who will eventually buy the software. If we hollow out the bottom of the workforce with digital labor, we might be cutting off the supply of our own future leaders.
That is a fascinating and, a slightly terrifying second-order effect. We might be automating the entire apprenticeship phase of a career out of existence.
Something for you to mull over as you watch that Mr. Beast commercial during the Super Bowl. That's it for this deep dive into Salesforce's agentic pivot. Thanks for listening.
Thank